In 1975, a man named John Bogle launched an investment fund that the entire Wall Street establishment called a threat to the American way. 45 years later, it had transferred more wealth to ordinary investors than any financial product in history. John Bogle founded Vanguard on a radical premise that the average fund manager, after fees, could not consistently beat the market, not because they were incompetent, but because the market itself is the sum of all investors. So by definition, the average investor gets the average market return minus costs. The higher the costs, the lower the return. Wall Street hated this idea because Bogle's low-cost index fund threatened their fee structure. At the time, actively managed funds charged 1 to 2% annually. A Vanguard index fund charged 0.04%. Compounded over 40 years, that difference is not small. On a $200,000 investment, a 1.5% fee difference costs you approximately $400,000 in lost compounding over that period. The investment community called Bogle's first fund Bogle's Folly. It launched with only $11 million, a fraction of its $250 million target. Today, Vanguard manages more than $8 trillion. The single most reliable, evidence-based strategy for long-term wealth building available to ordinary investors is consistent investment in low-cost index funds over decades. Not stock picking, not timing, not tips from your cousin. Boring, systematic, low-cost index investing. Every year you spend chasing performance over this strategy is a year you're paying Wall Street to lose your money for you. The next video reveals the exact behavior pattern that causes most investors to buy high and sell low, and how to permanently override it. Subscribe and protect your future returns.